Good evening and welcome. I'm Greg Stewart. Tonight, we're diving deep into a topic that sends chills down the spines of economists and everyday Americans alike: major U.S. bank failures. From the savings and loan crisis of the 1980s to the collapse of giants like Washington Mutual and Lehman Brothers, we've seen firsthand how quickly a seemingly stable financial system can teeter on the brink. We'll take you through the most significant collapses, decade by decade. We'll examine the mistakes that were made, the lessons that were hopefully learned, and the lasting impact these events have had on the regulations that govern our financial institutions. This isn't just about numbers on a balance sheet, it's about the human cost of financial instability. It's about the families who lost their savings, the businesses that shuttered their doors, and the communities left reeling in the aftermath. The 1980s marked a period of significant deregulation in the financial industry. The idea was to unleash the power of the free market, but the result, in part, was a wave of risky lending and investments, particularly in the savings and loan sector. Institutions, once pillars of local communities, began to crumble under the weight of bad loans and outright fraud. The images were stark and unsettling: lines snaking around bank branches, desperate customers trying to withdraw their life savings, only to be told the money was gone. The government stepped in with a massive bailout, but the damage was done. The savings and loan crisis left scars on the American economy that took years to heal. In 1984, the collapse of Continental Illinois National Bank sent shockwaves through the financial world. It was the largest bank failure in U.S. history at that time, a stark warning sign that even the titans of the industry were not immune to collapse. The government, again, found itself in the position of having to intervene, fearing the domino effect that the bank's failure could have on the entire financial system. The collapse of Continental Illinois raised a critical question: had some banks become too big to fail? The very notion that the government might have to bail out a failing institution to prevent wider economic chaos sparked intense debate, a debate that continues to this day. The failure of Empire Savings and Loan in 1984 exposed the dark underbelly of the deregulated financial landscape. It wasn't just bad loans that brought down Empire, it was outright fraud and criminal activity. Executives were found guilty of embezzlement, racketeering, and other charges, revealing a culture of greed and corruption that had infected some corners of the industry. The case of Empire Savings and Loan served as a harsh reminder that deregulation, without adequate oversight and enforcement, could create opportunities for unscrupulous actors to exploit the system and put depositors' money at risk. Chapter 4: Home State Savings Bank. When a state's financial system teeters. In 1985, the failure of Home State Savings Bank in Ohio triggered a chain reaction that crippled the state's entire banking system. The collapse exposed the interconnected nature of financial institutions, demonstrating how the failure of one could send shockwaves through an entire region. Ohio Governor Richard Celeste was forced to declare a banking holiday, closing all savings and loan institutions in the state for a week. The crisis in Ohio illustrated the essential role that confidence plays in the banking system. When depositors lose faith in the ability of banks to protect their savings, it can lead to a run on the banks, a self-fulfilling prophecy that can bring down even healthy institutions. Chapter 5: American Savings and Loan Association, A Giant Falls. As the savings and loan crisis reached its peak, even some of the largest institutions in the country were not spared. The 1988 failure of American Savings and Loan Association, with assets of over $30 billion, sent shockwaves through the financial system. Once a symbol of the California dream, American Savings and Loan became a cautionary tale of unchecked risk-taking and regulatory failure. The collapse of American Savings and Loan underscored the sheer scale of the crisis. It wasn't just small, poorly managed institutions that were failing, it was some of the biggest players in the industry. The costs of the crisis, both in terms of taxpayer dollars and lost economic output, were staggering. Chapter 6: Lincoln Savings and Loan Cheating. 5 Scandal Rocks the Nation. The 1989 failure of Lincoln Savings and Loan Association became synonymous with political corruption and regulatory failure. Charles Keating, the man behind Lincoln's downfall, used his political connections to influence regulators and lawmakers, delaying action against his failing institution even as it engaged in risky and fraudulent practices. The Keating Five scandal, as it came to be known, involved 5 U.S. senators who intervened on Keating's behalf with federal regulators. The scandal eroded public trust in both the government and the financial system, further deepening the crisis of confidence that gripped the nation. The 1990s saw a period of relative calm in the banking sector, but the aftershocks of the savings and loan crisis continued to be felt. The government created the Resolution Trust Corporation, or RTC, to clean up the wreckage of failed institutions, selling off assets, and recouping as much taxpayer money as possible. While there were fewer bank failures in the 1990s, the experience of the previous decade cast a long shadow over the industry. Regulators implemented stricter rules and oversight, while banks themselves became more cautious in their lending practices. The era of deregulation had come to an end, replaced by a renewed focus on financial stability. The collapse of Superior Bank FSB in 2001 marked the first major bank failure of the new millennium, a stark reminder that the problems that plagued the industry in the 1980s had not been entirely solved. Superior, a subprime mortgage lender, collapsed under the weight of bad loans, foreshadowing the housing crisis that would grip the nation just a few years later. The failure of Superior Bank demonstrated that even in a period of economic growth, the banking system remained vulnerable to risky lending practices and inadequate regulation. It served as an early warning sign that the financial system was headed for trouble. In 2008, the U.S. financial system was rocked by its biggest earthquake yet, the collapse of Washington Mutual, or WAMU. Once a giant in the mortgage lending industry, WAMU crumbled under the weight of its toxic mortgage portfolio as the housing bubble burst. With $307 billion in assets, its failure was the largest in American history. The collapse of WAMU was a defining moment in the financial crisis of 2008. It signaled that no institution, no matter how large or seemingly stable, was immune to the forces that were roiling the global economy. The government, facing a crisis of unprecedented scale, took the extraordinary step of seizing control of WAMU and selling its assets to J.P. Morgan Chase in a desperate attempt to prevent a complete meltdown of the financial system. IndyMac Bank, once a major player in the subprime mortgage market, became another casualty of the 2008 financial crisis. The bank's aggressive lending practices, coupled with lax underwriting standards and a reliance on complex financial instruments, proved to be a recipe for disaster when the housing bubble burst. The failure of IndyMac highlighted the systemic risks posed by the subprime mortgage crisis. As housing prices plummeted and borrowers defaulted on their loans, the losses rippled through the financial system, taking down not just individual banks but threatening the stability of the entire global economy. Although technically an investment bank, the collapse of Lehman Brothers in 2008 sent shockwaves through the global financial system. Lehman, a venerable institution with a 158-year history, had become heavily involved in the subprime mortgage market. As the housing bubble burst, the firm found itself saddled with billions of dollars in toxic assets. The U.S. government, having already bailed out several major financial institutions, made the fateful decision not to rescue Lehman Brothers. The firm's collapse triggered a global financial panic, freezing credit markets and sending stock markets into free fall. The Lehman Brothers bankruptcy remains a stark reminder of the interconnected nature of the global economy and the devastating consequences of a loss of confidence in the financial system. In 2009, Colonial Bank, a major regional bank based in Alabama, became one of the largest bank failures of the financial crisis. The bank's collapse was largely attributed to its exposure to risky real estate loans, particularly in the booming Florida market. As the housing bubble burst, Colonial's loan portfolio soured, leading to massive losses. The failure of Colonial Bank highlighted the widespread impact of the housing crisis. It wasn't just banks in major financial centers like New York and London that were affected. Regional banks across the country, many of which had invested heavily in real estate, were also at risk. The crisis exposed weaknesses in the regulatory system, which had failed to adequately monitor the risks taken by banks like Colonial. The 2017 failure of Guaranty Bank, a mid-sized institution based in Georgia, served as a reminder that the U.S. banking system was still grappling with the aftereffects of the 2008 financial crisis. Guaranty's collapse was attributed to a combination of factors, including bad loans, poor management, and a challenging economic environment. The FDIC, which had taken over hundreds of failed banks during the financial crisis, stepped in to protect depositors, selling off Guaranty's assets to another institution. The case of Guaranty Bank demonstrated that even years after the worst of the crisis had passed, the banking sector remained vulnerable to shocks and individual institutions could still fail. The 2017 collapse of First NBC Bank, the largest bank failure since the 2008 financial crisis, sent shockwaves through the industry. The New Orleans-based bank, once a pillar of the local community, had become entangled in a web of risky loans and questionable accounting practices. The failure of First NBC Bank raised concerns that the lessons of the financial crisis had not been fully learned. It highlighted the importance of strong corporate governance, effective risk management, and vigilant regulatory oversight in preventing future bank failures. The 2020s have ushered in a new era of uncertainty and volatility for the banking sector. The COVID-19 pandemic, with its unprecedented economic disruptions, exposed vulnerabilities in the financial system, leading to the failure of several significant institutions, including Signature Bank, Silicon Valley Bank, and First Republic Bank. These recent failures serve as a stark reminder that the banking system is not immune to the forces that shape the global economy. They underscore the need for continued vigilance, robust regulation, and a focus on building a more resilient financial system that can withstand future shocks. Thank you for watching our special report on major U.S. bank failures. We've journeyed through decades of financial history, witnessing both the triumphs and the tragedies that have shaped our banking system. For more detailed information, visit the Federal Deposit Insurance Corporation, FDIC, website. Understanding the causes and consequences of bank failures is essential for all of us. It's about protecting our savings, ensuring the stability of our economy, and holding those entrusted with our financial well-being accountable. Stay tuned for more updates and in-depth analysis on our channel as we continue to explore the complex and ever-evolving world of finance.